All right. Good morning, everyone. Welcome to the Thursday Elite Zoom training. Today, I had a special request from one of my agents who wanted to do children's IUL with FNG, and she was trying to learn the illustration software, and she had some questions about that. And I wanted to kind of address that today and also make it a training, right? And FNG IUL, I think it's one of the best IULs you can get for a child because of the high potential interest rate that it has been giving to our clients over the last 20 plus years. Also, the overall, I think the price point of the IUL versus the growth, and also how you can maximize the IUL to max fund the policy as a tax-free retirement plan or a college plan. I think it's really flexible. So I wanted to go over that today. So first of all, you can go to hq.quility.com. This is your homepage. And under the sales tools, you're going to go to carriers and products. And then carriers, you see explore now, FNG. You see agent login. And once you click that, you're gonna go to this website, click login, financial and insurance professional. Then you're gonna use your information to log in. And they have this new two-step process verification where you have to change it to an email now. So make sure you get that done. I've been just delaying it. I have 8 more days because usually when I'm on this website, I've been pretty busy. But yeah, you have to get that done sooner or later. On this website, under the sales tools, you go to illustrations and FNG Life Illustrations, explore. Okay, and we're gonna start a new case. I wanted to give you a training on two different types of illustration. Okay, so I'm gonna explain to you why I do it like this, and also give you a reason why you should use the other type of illustration. So first of all, let's talk about a client who might be, let's just say child, and we're gonna put child one. So where the name goes. And what we're going to do is we're going to use an example of maybe like a 10-year-old as an example. So we're going to put 10. Uh, we can make it male, Nevada. Product type, Index Universal Life. Find available products. There's FG Everlast and FG Pathsetter. So the Pathsetter is the one that you can really customize for the client. So I will choose the FNG Pathsetter. Click select the quotes slash illustrations. And this is the illustration platform. And I'm just going to put parent, but this is where usually your client's name goes, the parent or the grandparent of the child. And then when you scroll down, this is where it's very important. Under solves, it says solve for, and it has none. So what I typically do is if you wanted to kind of max fund the policy for the client, and also generate good income in the future, then max accumulation income is a great solve. Okay, so if you wanted to, I'm going to show you the easiest way to do the illustration first. Okay, you don't have to do too much. What is one of the easiest way to do this and what it will look like? So going back again, as soon as you get in here, you're going to change the solve for to instead of none, you're going to change the maximum accumulation and income. And once you do that, this screen will pop up and leave it as solve for at face amount because a lot of the times the children's policy, the parents want to put a certain amount of in, right? So you want to put in the premium that client desires, and we're going to solve for the face amount. If you wanted to put the face amount the client desires, let's just say it's $300,000 coverage client wants, then you're going to click solve for premium so you can solve for how much premium the client has to pay based on a $300,000 death benefit. So leave it at face, okay? Leave it at face and specified premiums. You click on that. Monthly premium, you see $0.00. You're going to click on that and put the desired amount of how much the client wants to put in. So let's just say usually, and this is a good general like rule of thumb is if you wanted to have the client pay minimum, I would say $50 is the absolute minimum that I recommend on an IUL for children. Couple reasons. One, because if we go less than $50, the not much of the cash value really goes to the premium goes to the cash value. Yeah, let me just go ahead and mute some of the people. Okay. And so $50 is kind of the minimum that I recommend. And most of the time I say about $100. Okay. But I'm going to use a 50 to make it easy. So we're going to put 50 and I'm going to click on this check mark. When you do $50, it changes everything to $50 monthly, right? And then we're going to scroll down and there is a button called OK. Click on that. And pay premium to. So this is determining how long the client wants to pay the premium for, or what up to what age the client wants to pay the premium up to. And if you take a look at this little blue eye icon, and it tells you A, if you put an A in front of the number, that means the premium is going to be paid until age 65. If you put a Y, it means that you're going to be paying for that many years, 20 years of premium. Then that'll be Y20, right? Does that make sense? So typically what I do, I know this is a children's policy and maybe they want to use it for college, but I don't usually put only age 18. Why? If I only put age 18, that means the premium is not, if it's gonna show, it's only gonna pay until the child is 18 and there's no more premium going in. If that's the case, I just gave you an example of a child who's 10 years old. 10 years old to 18, that's only 8 years. That's not enough time to let the policy really grow. So I do a standard, put a capital A, and I put 65. Why? Because if the child used some of the money for college, but then later they want to use it to maybe put down on a down payment on a house or buy a car or use it for business expenses. Down the road, they want to use it for their retirement in the future when they get older. So I always put A65 as a good measure of how much premium should be going in. The client doesn't have to do this, by the way. This is just an illustration. So if the client put A65, I made an illustration to pay until age 65, but client only pay up to 40, 30, 20, it doesn't matter. They can change it at any time. It's a super flexible plan. I'm just showing them an illustration of what potentially this could grow up to be for the child in the future. All right. Because college plans, like 529 plans, those are great because you're still putting money aside for your children, and not a lot of families do that. But at the same time, it stops at college level, right? Once you go to 4 years of college, you use all the money in the 529 plan and it's gone. So where is the accumulation after the child graduates college? It's gone, right? So it was only for college and that's it. That's the purpose. Whereas if you set up a good IUL, max funded IUL policy, then not only college, but when they're, starting their years as a young adult, they're getting a job, they're trying to buy a house, they're trying to buy a car, whatever they wanting to do. This is going to continuously grow throughout their lifetime. And let me tell you, the compound interest favors the people who are younger. Why? Because you have so much more time to double the money. So the best time to set up an IUL is younger the better. Okay. Still, it's good if you set them up at 50, 60 years old. It's still an amazing plan with living benefits and cash value, but nothing like starting it at age of 0, 1, 2, 5, 10, whenever they find out about IULs. So that's the financial educational piece, right? So age 65 is what I'm going to put. You don't have to change anything. Cash value at A120. Don't touch anything there. Income stream. So this is showing a monthly income stream and it says loan. The reason why we put loan instead of withdrawal is because when you under the tax code 7702, if you were able to take out the cash value from the life insurance policy as a loan, then it's not taxable. So we're using that loan feature, that tax loophole where client can receive a tax-free loan as an income for the rest of their life. But I know clients are like, oh, but it's a loan I have to pay back. No, it's not. So because it's a loan against your cash value and death benefit of the policy, when the client passes away, the amount that you took out as income, that just gets reduced in the death benefit. So you don't have to pay it back. Actually, manually, you have to pay it back with your money. All right.
Sean, can I jump in with a question real quick about
Yes.
that?
Go ahead. Yeah,
So,
go
because
ahead.
I've had that same question as well about paying it back. And I guess my question is when it is getting paid back through your death benefit after you pass away,
Yeah.
is it also at that loan amount with that percent? And, how do those numbers really even out? What does that look like?
Yeah. So I'll just give you an example. Let's just say a client had set up a children's plan and the death benefit went up to $1 million in the future. Let's just say client died at the age of 75 and the death benefit was 1 million. The client started taking out an income at 65, and let's just say they took out about $200,000 of income. Then that $200,000 of income gets minus from the $1 million death benefit. So then the family will receive an $800,000 tax-free death benefit.
Okay, so
Does that
there
make
it
sense?
doesn't have to be paid back at the loan percent.
No, not at all.
Okay,
It's
that's
just
where I was confused. I didn't realize. Okay, that's great. Thank you.
yeah, you're welcome. So that's why this is a superior product, in my opinion, to just like putting into a savings account or putting into a 529 plan, because I'm gonna go into it even more about that. But it just first of all, able to compound it for the rest of your life. Secondly, the market downside, you don't have to worry about that because it all has a market downside protection of 0% floor. Actually, in this product is 0.25% floor. So even if the market crashes, you're guaranteed a 0.25% interest on your IUL. So it's protected, it's compounding, it has living benefits also. You have critical, chronic, and terminal illness riders included at no extra cost. So if you had a cancer, heart attack, stroke, right, major organ failure, like Alzheimer's, like dementia, maybe you have Lou Gehrig's disease. You have a chronic illness where you need to go to a nursing home or somebody needs to come to your house and take care of you because you can't do 2 out of 6 activities of daily living, right? So these are included in this plan. So it's not just about wealth accumulation, but it's also a protection for the family. And at the end of the day, it's tax free if you strategically use this and properly structure it, right? So typically, I start the income at the age of 65, and then years, I just leave it at 25. So that means between age 65 and 90 years old, this particular child, when he becomes 65 years old, he's going to be able to receive an income for 25 years until 90 years old, which is amazing. You can make this longer or shorter, by the way, but right now, the Americas, I think the average age of death is around 79 years old or so. So 90 is still a great longevity still yet. But by the time they become adult, maybe 90 is pretty common because of the advances in the um, medical field. So what I'm thinking is this is a great illustration like this, 65 for 25 years until 90 years old. And then the only thing you need to do is click
Mm.
OK. And initial face amount, you don't have to really change anything here because this solve for max accumulation and we put $50 a month, that overrides everything else. So I'll leave it at this. If it's $50 only a month, leave the death benefit option at option A. Okay, this is a good, safe way for you to do it. Why? Because sometimes if we try to minimize the death benefit too much to maximize the cash value, then sometimes what happens is there's not enough room in the future for the parents to put more money in there without being taxed. It's each IUL has something called a MEC, Modified Endowment Contract. You also can look it under 7 pay. So that means government puts a ceiling of how much money you can put in based on the death benefit that the client gets when they start the policy. So if you put more than that, then the policy becomes taxable and it defeats the purpose of having an IUL, right? So option A is a very safe way for you to start the policy for the client. By the way, in the future, client can change this option A to option B. So what does that mean? Option A is level death benefit. That means the client gets a death benefit of, let's just say 150,000 as an example, then that stays the same. Option B means that it's an increasing death benefit. If the death benefit was 150,000, it's going to keep going up 151, 152, 153,000, and it's keep going up throughout the years. So setting up as an option A is good still because later client can always turn it on for the option B to increase the death benefit in the future. But as a $50 premium, it's good to start at option A. And I'll tell you another reason why. When you do option B and do a max accumulation income solve, and I'll show you what I mean by that. Let's start with option A first. Option A, 150,000, leave it as it is. You can leave it as it is because the solve for maximum accumulation and income overrides everything else. So under interest and crediting option, the best way you can really choose the best allocation for the client is look at the illustration rate. Currently, the best performing one is Morgan Stanley US Equity Allocator with 7.20 illustration rate and S&P 500 annual point-to-point 100% participation 7.05. So what I do is I erase the ones that have a lower one and you just change 50% to the 7.2 Morgan Stanley. You zero out the BlackRock, S&P. There you go. S&P annual point-to-point 100% participation. So you 50-50. You're diversifying a little bit. That looks good. So it should combine to be 100%. Loan withdrawals, you don't have to worry about that. So once you're done with this, you click on View and Print Illustration. So what this does is it creates like a 20 plus page illustration, and it's going to have all the details of how the cash value is going to grow, what the benefits are. So what I'm going to do is I'm going to save this so I can show a comparison as well. Let me go ahead and explain this first. So child one, that's what we named child. Male, 10 years old, non-tobacco. Face amount, it's 122,491, right?
Hello, baby.
Okay, guys, please keep yourself muted. All right. So the $50 a month, what it did is, do you remember we chose the max accumulation and income solve for? You remember? Let me go back and show you here. Do you remember we chose under solve for? It says max accumulation and income. So what this does is it forces the illustration to show you what's the least amount of face amount that they can give you for a level policy for $50 a month. All right. So when you scroll down, the tabular detail usually is on page 11. It starts at 11. So if you take a look at this, non-guaranteed assumption, current interest rate. So this is the actual average over the last 20 plus years. Okay. So this is what the reason why it says non-guarantee is they're not guaranteeing you a 7.13, but we can show you what it has done over the last 20 years. You remember I told you the 0.25 is the floor? That's the guaranteed rate. But this is assuming that if the market never ever gains more than a 0.25%. So this is assuming the market is negative pretty much back to back to back 10, 20, 30 years. So is that realistic? Not really. There's not more than 3 years back to back negative years in the stock market. So that means this is unreliable because this is showing negative for 10, 20, 30 years. So you're not going to go with that. But contractually, they have to show it to the client. The non-guaranteed assumption alternate interest 4.75, they're showing a number that is way less than what the current is as another type of scenario. But this is also not as realistic because 4.75 is not what the market has done. It's been over 7% that what the market has done. So this is just showing you in case of a market crash that happened a lot more frequent, 2 to 3 times more than usual. And I think this one is also not as reliable because history tends to repeat, right? Market goes up, market goes down. So this is the actual average of what it has done. So this is what I go by. Okay. So when you go down here, the death benefit is 122,491 and it stays the same, correct? And the account value. So this is the cash value we call it that grows throughout the lifetime. And the cash value continues to grow. And when you look at the age 66, what happens? Do you see that plan premium of $600 a year, which is $50 a month? That was the monthly premium. Remember on the illustration software, we put that at the age of 65. We're going to be done paying for the premium. So it stops. At 66, it stops. No more premium. But if you take a look to the right, what does it say under withdrawals and loans? You start taking out at $20,440 a year tax free, right? So then every year, starting at age 66, gets an income of $20,000 or so passively a year tax free. And this continues until the child is 90 years old now. And if they live up to 90, they would have withdrawn how much? $510,000 in tax-free income. And how much did the parents and the child put in? Only $33,000 in total over 50 years. Only $33,000. And the client is able to withdraw $510,000. And that's kind of the power of compound interest, what I was talking about. If the same person put in $50 for the child into a savings account with a 0.04% national average, where would the money be after 50, 60 years? Maybe $34,000, if that. You know what I'm saying? The compound interest, that's why it's so important. You're making money while you're sleeping. And at this point, let's just say client passed away at the age of 80 unexpectedly. So that means how much did the client withdraw in income up to age 80? 306,000. But if you look to the right, what does it say on the net death benefit? 164,000. So that means this client withdraw an income of $306,000 from age 65 to 80 years old, passed away of a heart attack, and now the family still receives a tax-free death benefit of $164,000. So That's why this program is incredible. And also another thing, let's talk about the living benefits. You see the critical illness, chronic illness, terminal illness. You get up to 100% of the death benefit, up to 1 million in case of a heart attack, stroke, cancer, all these stuff. So these are included. So that means in case the client had a heart attack at the age of, let's just say 65, what was the death benefit? It's 274,000, right? Then they can get up to 100% of the death benefit as a lump sum because of the heart attack. So that's just an example of what they can get. This is a good standard illustration, and why also as an agent that this is better for like a $50 a month premium is because if you do the other way, let me just show you what I mean by that. Let's go ahead and change this to, do you remember we chose option A? Let's just change it to option B. If I change this to option B, max accumulation and income, then let's see what happens. Only thing I changed was option A to option B on the illustration, all right? Okay, let's save this one too. Let's go down to, yeah, tabular detail. Look at the death benefit now. What does it say? It's $50,000 in face amount. The other one was how much? 122,000, right? So it's forcing, because you chose an option B as the max funding, it forces the death benefit to be the minimum possible. So it's $50,000 face amount, correct? And what happens is if you go down to the page 22, what is the target premium? So this is what you get paid commission on. All right. Not what the client pays monthly. Even if it's the same $50 a month the client pays, the $50,000 death benefit one that you pay $50 for, target premium is only $180 a year. So you know what that means? Your commission is going to be only based on $180. So you have to multiply the commission rate on this product. So let's just say it's 60, 70, 80%. So then that's the only commission you'll get. It's less than $100 for setting this up. Whereas the level one, I did the max accumulation income solve, but option A, when I scroll down to page 22, it's $440, more than double, right? So that means even though the client is paying the same $50 a month, if you set it up this way, your commission is going to be $200 plus. If you set it up this way, your commission is less than $100. And I just wanted to show you this so you're aware of this, okay? And as an agent, you need to be able to find a balance between setting up the policy to fund the cash value and also that you're not working for free either. You're not a volunteering here. Okay, so I just want you to know this so you can design the policy the best way you want to do it for the client. And I'll tell you why also I don't like this option B sometimes with the max accumulation. Because if I set it up this way, look at the 7 pay. It's $2,012 a year. So that means, you remember I told you about MEC? MEC is modified endowment contract, and government puts a ceiling of how much money you can put in every year for the first 7 years. So you can only put $2,000 a year as the max amount ever in the first 7 years. So that means $2,000 is what? Like 100 and what? $80? or so, 175 to $180 a month. That's it. So if the client wants to put more money in there, they're limited. They can't even put a couple of $100 a month into this in the future. As the child becomes closer to the college years, there's not much room there. Ceiling is too low because the death benefit is only $50,000. But if you go to this one, same $50 a month policy, but the death benefit started a little higher and it's on option A right now, then what happens? Seven pay is $4,929. So how much is that? That's over $400 a month the parent can pay in if they wanted to overfund for the child for the college. So why I would set up option A just on default is because, first of all, you can always change it to option B in the future as a client. They can call in and say, hey, I have option A right now, but I want to change to option B and I want to increase the death benefit, then they can always do that in the future. And then number two, the ceiling is way higher. Maybe the parents say, hey, college is coming up in 5 years and I want to put $400 a month instead of $50 a month. Then they still have the option to do it. The other policy, because the death benefit is so low, your ceiling is only $2,000 a year. That's it. So even if the client wants to put more in there for the child, they can't without being taxed on the whole thing. So it's a balance between the two. So you leave enough room for the parents to put more money in there by having a higher death benefit because the death benefit initially determines the MEC, the seven pay, how much money they can put in without being taxed, right? And then secondly, as an agent, you're not working for free because if the death benefit is so low and target is so low, then that you're gonna get paid pennies. And if you're not gonna survive in this business by making enough money, then you're most likely not gonna be here. So it's a good balance that you need to find. Okay. And I'm going to show you one more thing. So this is the standard. Okay. Standard is, I'm just going to go over it again. So it's a good reminder. Solve for max accumulation and income. And you're going to put specify premium and you're going to put the amount that the client desires to put in, right? $50 or $100. But let me show you something else. In case it's like $100 or more, if it's $100 or more, then there's another way you can set it up. So I'm going to show you an example. $100 this time. Okay. So that's $100 a month, paid to age 65, income starts at 65. So this is standard. And here, one of the things that you can do, you can make it option B, but I'm gonna try to see if we can increase the death benefit a little bit. So let's go ahead and try this. Do you see on here there is let me take a look here. So max accumulation income, we're gonna go ahead and try to override this a little bit. So we're gonna try to put 200,000 dollars or $250,000 on here. And if you remember, for $50 a month, what was the death benefit on the other policy? It was around for the level. $50 got them about 122,000, right? So what we can do is we can make this death benefit option A and put about 250,000 because that's double the 120 the $50 a month, $125,000 death benefit. And we're gonna go ahead and click view and print illustration to take a look at it. So the best way for you to do it is kind of play with it and see what it looks like. And do a take a look at the PDF file. If it doesn't look as good, then you can tweak it a little bit. So it's very flexible plan and you get better as you practice more and more. So this one, okay, so I'm gonna go ahead and click Save View as PDF. So $100 a month is how much face amount? It's 274,000. When you scroll down in the tabular detail, it will show you $100 a month policy. will give them a death benefit of $274,000. So this is also a good illustration for you to do. Okay, so keep it simple, especially if you're pretty new and you're just learning about this. Keep it at max accumulation and income and option A, death benefit. Okay, so this is the standard. And what I can do is this. Next week, I can do an advanced version of this where you can design it even more intricately. But the thing is, that one is definitely more advanced. So if you're just doing $50 to $100 a month, just do max accumulation and income and put option A as a death benefit. Any questions? Veronica Sanchez is tax-free, but do they pay taxes on the interest? No, it's completely tax-free. If they have a heart attack at 65 and take the lump sum, can they still take retirement money at each year on top of that? Great question, Cami. No. If they were taking out, let's just say they took out 90% of the death benefit because they had a full-blown heart attack and they were able to take out that much, then the cash value will not be still there for the full amount. Okay. So that's a very good question. In that case,
Sean,
it'll be more like either or, but another way is this, and that's something that I'll talk about next week, is we can design it so that the client can take out a lump sum and still they could have a potential retirement income, and we can set it up that way, but that's a little more advanced and also most likely it'll be a better program for clients who are putting in more money in there than just 50 to
Sean,
$100.
Sean, I
Yeah.
have a
Yes, thank
question.
you.
Yeah.
Can you hear me?
Yes.
Okay, with this IUL,
Hmm.
can the client put a
Hmm.
lump sum money, let's say
Yeah.
5,000, they have money in the bank. Can they do that?
Only up to the maximum amount that is allowed. The
But they can
MEC.
do.
Yeah. They can put in if there's enough room in the ceiling. If the MEC
Mhm.
is, let's just say the MEC for the year is $10,000 a year, then they can put in a lump sum of 5,000 and it shouldn't be any problem there.
Other question. Let's say they put 2,000. How soon
Mm.
do you think they can loan it,
Got it.
the lump
Yeah,
sum?
good question. If you're thinking about like an infinite banking concept,
Mm-hmm.
to take out the money right away, then IUL is not the best fit. You want to do a participating whole life from Foresters, like Live Well Plus,
Ah,
because the biggest difference between a whole participating whole life and the IUL is that participating whole life has a liquidity of up to 90% of the surrender value after the
mhm.
first month.
I
Okay.
see. I got it.
But IUL in the first 3 to 5 years, the surrender fees are pretty high, so you don't have as much money accessible to pull out.
Mhm.
So IUL is better long term because it has a higher interest growth because it's tied
Mhm.
to the market. So IUL is better for long term, like retirement or children's college funding in more than 10 years growth,
Mhm.
whereas
So,
the whole life is
so,
better for right away, using the money right away.
so, in short, if I bump with somebody who's a businessman, let's say they have 10,000 that they want to
Mhm.
put in. So they put in the 10,000, and then after about when the surrender value came out, they can withdraw already up to 90% of the 10,000 that they put. But even though they loan the, let's say 90% of it, but it's still the money that is growing is still the same because the death benefit is the collateral, right?
It is, but there is a loan payment that is paying back to the
Mm-hmm.
company. So yeah, it's called a non-direct loan recognition. So yes. So the answer is yes, but it's more than that. It's the way you explained it is very simple, but inside the policy, yes, the cash value still grows on the interest is growing on the cash value, but there is also the portion that you took out as a loan of 90% that you still pay a loan interest back, which gets pretty much washed by the dividends and the interest you're getting. So you're
Mm-hmm.
pretty much loaning the money for free. You're not paying any
Mm-hmm.
interest on you're borrowing.
Usually the interest when you loan is between 4 to 5%, right?
Yeah, yeah,
Okay, gotcha. Thank you.
yeah, you're welcome. Can a client always switch back from A to B? Yes. Yes, you can. So you can make it option A to B, or you can make it B to A.
So once a
The
year,
way I'm
Sean?
understanding, you said what?
Once a year, I think.
Yeah. The way I'm understanding it, option A sounds better, not just for the agent, but for the client as well. So, yeah, it's a good question. So option A is good because for the max accumulation income, by the way, for this particular solve, Cammy, this particular solve, it makes the most sense to go option A. Um, because the option A means the death benefit doesn't keep increasing, so the cost of insurance is not keep going up every year. Whereas if you do the option B, that means the death benefit goes up a little bit every year. That means the cost of insurance goes up every year. Okay, so if the premium is small, that's why I don't usually recommend the option B because then that means you're already putting in a small amount monthly, but the internal cost of insurance is keep growing, then it might not be the best illustration for the client long term. Secondly, if you don't have enough ceiling, like if you make the option B and the death benefit is so low, like 50,000 you sell for $50 a month policy, then the ceiling is only $2,000 a year. So the parents want to put more money in there, they can't even do it without having to be penalized tax-wise for the IUL policy. So I like to set it up so that there's enough room that client can start paying 50 to 100, but if they wanted to, they can put two, three, $400 a month into it if they wish to.
That makes sense, Sean. Thank you. But that's for option A, right?
Yeah, yeah,
So
option
why
A.
would someone want B? Because that sounds a lot better. And so yeah, why would they want B?
Yeah. Yeah, that's a good. Yeah, so option B, by the way, it can be very beneficial to the client. So I'll give you an example, Cami. So if you go with the option B, the illustration wise, let's just say death benefit started at 250,000, but the death benefit keep increasing and it grew to $500,000. That means client has the cash value on top of the death benefit. So that they're because option A, you get either or. You either get the take out the cash value, then the death benefit goes down that much, right? So if you had a $250,000 death benefit and you have 50 grand in there, when you take out the 50 grand, your family only gets 200,000. If you do option B, if you do option B, then you started with 250,000, but as the death benefit goes up, your cash value that you're gaining, that gets added to the initial death benefit. So it was
Got it.
250, but $10,000 cash value went in, then now the death benefit goes up to 260. So even when the client takes out about 10 grand, they still have the initial death benefit amount that they signed up for.
That makes sense. Was that the option when you were showing? So there was like example $1 million cash value. They took out
Mhm.
200,000, and then family got 800,000 when they died. Was that the
That's
A
option A.
option or
That's
the B
option
option?
A. That's option A. So
Okay.
death benefit is 1 million and you took out 200,000, then that gets minus from the death benefit, right? Whereas in the option B, the death benefit will be 1.2 because the $200,000 cash value was added to the death benefit. So even if you take out 200,000, how much is still left?
Yep, the
A
million.
million. Yeah, still. So the family will get $1 million when they pass. So there is an advantage in both. But I was just
Yeah.
saying that for $50 to $100 a month child's policy, option A is a great option to start the policy. And because the client can turn off the option A and B at any time. If you're doing with a adult client, the target premium is higher in general. So option B could make sense. So if let's just say I have a client who wants to put 500 to $1,000 a month, then it might be better to structure it option B because you have plenty of money going in that we can structure it correctly, and they're going to be able to get higher death benefit in the future and also have more cash value in the future. But it's very intricate for that one. So just for the children's policy, option A is a good way for you to start the policy. And so that the client has more room to pay more money in there for the child in the future without having the ceiling so low. And secondly, as an agent, you're not gonna just get paid like $50 for setting up a whole IUL for the child, and
Mhm.
now you're not making enough money. Okay?
Thank you for clarifying.
Yes. Yeah, you're welcome. All right. And
Quick question.
yeah,
It seems like I don't know if it's a rule or if it's just the way it works out, but at 250, your cost of life insurance gets lower with a lot of these companies. So if someone's writing 200 and you write 200 and you go down to like the second page, the cost of insurance, and then you do 250, seems like the cost of insurance, they get a cost break at like 250,000. I don't know if you've noticed that.
yeah, yeah. You can get a little price break of death benefits, kind of like bulk buying in a way for life insurance. So yeah, you could get a price break that way as well. But I just like to give enough room that because let's just say, as an example, I know this this training got longer than I thought, um, as an example, this $50 a month one that we did for 50,000 increasing death benefit, look at the death benefit. It only amounts to be not much. Like for example, do you see that? Take a look at this. So if they had a heart attack, stroke, cancer, do you see the death benefit is quite low? So even if the client wants to get living benefits, it's not going to be a lot of money. So that's another thing about it. If you set it up too low of a death benefit, then they're not going to even really get the benefit of having a living benefit. So that's just be something to be aware of. Okay. So having enough death benefit, I think it is important because it's not just about investment, it's also about financial protection in the future. Okay, what happens if the parent dies? Can one take over premium payments? Oh, like a parent? Okay, so if the parent passes away, yes, then somebody else can take it over with the premium payment, or hopefully by then there's enough premium paid in the policy that the policy will carry over as well. Okay. All right, guys. So it was a good training. And next week, what I'm gonna do is I'm gonna do a little more advanced illustration where we're gonna use option B, but it has to be strategically designed so that it's set up correctly for the client, like a max funding policy. If you talk to a business owner and they want to put like $1,000 a month, and I'm gonna show you an illustration based on that next week. All right. So have a good rest of your week, and I'll see you next time.